When silver stopped being just a metal, asterisk asterisk for most people today, silver feels like an afterthought. It sits quietly beneath gold in conversations, charts, and headlines, mentioned occasionally, rarely respected, almost never feared. Yet this calm indifference is a recent phenomenon, not a historical one. For thousands of years, silver was not treated as a speculative asset or an industrial input. It was treated as trust itself, solid, measurable, and difficult to fake. Long before modern banking systems existed, silver moved between hands as a promise that did not depend on governments, institutions, or belief. It simply was. Across ancient civilizations, silver formed the backbone of daily economic life. In Mesopotamia, debts were recorded in silver weight, not gold. In Rome, soldiers were paid in silver denarii, a form of compensation meant to carry value across distance and time. In medieval trade routes stretching from Europe to Asia, silver was the common language between cultures that shared nothing else. What made silver different was not beauty alone, it was usability. Unlike gold, it could circulate widely without being cut into dust. Unlike copper, it held value across generations. Silver existed in that rare middle ground, scarce enough to matter, common enough to move. Over time, something subtle changed. As financial systems grew more complex, trust slowly migrated away from physical things and into paper promises. Coins became certificates, certificates became entries, entries became signals floating inside systems too large for most people to see. Silver didn't disappear, it was simply pushed aside, quietly reclassified from foundation to background. By the 20th century, silver had been stripped of its old identity. No longer money, no longer a pillar, just a metal, useful for photography, electronics, jewelry. Its historical role faded from memory, replaced by price charts and commodity labels. But history has a way of resurfacing during moments of stress. Whenever systems become stretched, whenever debt grows faster than confidence, whenever trust must be rebuilt rather than assumed, silver begins to reappear not loudly, not dramatically, but persistently. It shows up in central bank vaults, in long-term contracts, in strategic stockpiles, always quietly, always without announcements. This pattern is not accidental. Silver does something paper cannot. It settles. It closes the loop. It doesn't require confidence in future behavior. It only requires recognition of present reality. That simple property made it indispensable for centuries and makes it relevant again when systems feel fragile beneath the surface. The modern world often assumes progress means replacement, that newer systems eliminate the need for older ones. But financial history suggests something different. It suggests layering, new structures built on top of old foundations, not instead of them. And when pressure increases, those foundations begin to matter again. This is where silver's reputation quietly shifts, not as a hedge, not as a bet, but as a reference point, a material reminder of value that exists outside digital abstraction. It becomes less about price and more about positioning, less about profit and more about resilience. When viewed this way, silver stops being cheap gold or a volatile trade. It becomes something else entirely. A stabilizer, a signal, a tool that systems return to when certainty matters more than speed. And this is the moment we find ourselves approaching now, not because silver is suddenly fashionable, not because markets are excited, but because beneath the calm surface of global finance, something is being reevaluated, quietly, methodically, without headlines. To understand why this matters today, and why one country in particular has never forgotten silver's role, we need to look at a civilization that remembers what metals were used for long before they were priced on screens. And that story begins not in modern markets, but in China's long and unusually practical relationship with silver itself. China's long memory with precious metals, asterisk asterisk, China's relationship with silver has never been emotional. It has always been practical. While many civilizations treated precious metals as symbols of power or conquest, China treated silver as something far more grounded, a tool for order. For centuries, silver was not just accepted in China. It was integrated into how society functioned. Taxes, wages, trade settlements all quietly leaned on silver's reliability. During the Ming Dynasty, silver became the backbone of the monetary system, not because it was fashionable, but because it worked. Copper coins handled daily transactions, but silver settled obligations that mattered: land taxes, large trade balances, and state revenues. The system understood scale, it understood limits, and it understood trust. What is often missed in modern discussions is how deeply this shaped Chinese thinking. Silver was not viewed as wealth to be displayed, it was viewed as balance, something that kept systems aligned. When silver flowed smoothly, administration remained stable. When it didn't, stress appeared quickly and visibly. This sensitivity left a lasting imprint. China experienced firsthand what happens when silver supply tightens. In the late Ming period, disruptions in global silver flows, particularly from the Americas, caused internal strain. Taxes remained fixed in silver, but silver itself became harder to obtain. The result wasn't theoretical. It was immediate. Farmers struggled, trade slowed, confidence weakened. These were not abstract lessons. They were lived experiences recorded carefully by bureaucrats and scholars who understood cause and effect. Silver shortages were not blamed on markets or speculation. They were treated as structural problems with real consequences. Over time, China adapted, but it never forgot. Even as dynasties fell and systems changed, silver retained its reputation as something dependable when paper promises failed. This memory carried forward, quietly embedded in institutional thinking rather than public debate. While other nations experimented with aggressive monetary expansion or symbolic currencies, China remained cautious, measured, and observant. Fast forward to the modern era, and this historical awareness still echoes beneath the surface. China does not speak openly about monetary anxieties. It rarely announces strategic intentions directly. Instead, it observes, accumulates, adjusts. Its approach to metals reflects this same temperament. No excitement, no public campaigns, just steady positioning. Silver fits naturally into this mindset. It bridges the physical and the functional. It supports industry while retaining monetary characteristics. It exists outside purely digital systems while remaining useful in a modern economy. From electronics to energy infrastructure, silver is consumed, not just stored, a feature that quietly tightens supply over time. But beyond utility, silver represents something deeper for China: optionality. It provides flexibility without confrontation, security without declaration, a material asset that does not challenge existing systems directly, yet does not depend on them either. In a world of growing financial complexity, this quiet optionality becomes valuable. This is why China's interest in silver does not appear sudden when viewed through a longer lens. It is not a reaction, it is continuity. The past informs the present, not emotionally, but methodically. Lessons learned centuries ago remain relevant when trust, trade, and stability intersect again under new conditions. And this is where the modern story begins to take shape. Because when a system remembers something others have dismissed, it gains an advantage that doesn't announce itself. It doesn't need to persuade, it only needs to prepare. As we move forward, the question is no longer whether silver matters to China. That has already been answered by history. The real question is why this relevance is becoming noticeable again now, and what conditions are quietly bringing silver back into focus on a global scale. That shift takes us out of the past and into the present, where modern systems, energy demands, and silent financial pressures begin to align in unexpected ways. And that is where Chapter 2 begins. Why China's system quietly favors silver again, ***, in the modern world. Needs rarely announce themselves. They emerge quietly, shaped by systems rather than slogans. China's renewed alignment with silver follows this same pattern. It is not driven by ideology nor by public declarations. It is driven by structure. China's economic system is built around long-term continuity. Infrastructure is planned decades ahead. Energy demand is modeled years in advance. Supply chains are not left to chance or short-term market sentiment. Within such a system, materials are evaluated not just for cost, but for reliability under pressure. Silver performs well under that kind of scrutiny. At the industrial level, silver has become increasingly difficult to replace. It plays a critical role in electronics, energy transmission, and solar infrastructure, areas China has invested in heavily and systematically. Each expansion of these sectors quietly increases silver consumption. Unlike gold, which is mostly stored and recycled, silver is often used in ways that permanently remove it from circulation. This creates a subtle but important dynamic. Demand grows steadily while recoverable supply tightens. There is no urgency in this process, no dramatic shortages, just a slow shift in balance. For a system designed to think in decades, such trends matter far more than daily price movements. But industry alone does not explain silver's renewed importance. China operates within a global financial environment dominated by debt-based currencies and layered credit systems. These systems function well during stability, but become fragile when confidence weakens. Physical assets, especially those with historical monetary roles, offer a form of grounding that digital instruments cannot fully replicate. Silver occupies a unique position here. It is accessible enough to be accumulated quietly, large enough in scale to matter, yet small enough to avoid drawing attention. It does not challenge existing monetary structures openly, but it does not depend entirely on them either. This makes it an ideal asset for diversification without confrontation. China's approach reflects this subtlety. Rather than framing silver as a monetary alternative, it is treated as a strategic material with multiple roles. Official language remains focused on technology, sustainability, and industrial growth. Beneath that surface, however, silver provides optional resilience, a buffer that exists outside purely financial abstractions. What becomes clear is that silver fits neatly into China's preference for layered security. No single solution, no single dependency, instead, overlapping systems that reinforce each other quietly. Energy supports industry, industry supports trade, trade supports currency stability. Silver touches each layer without dominating any one of them. This is not accidental design. It reflects an understanding that modern risks are not singular events, but accumulations. Small stresses across multiple systems can compound unexpectedly. Materials that perform consistently across different scenarios become valuable not because they promise returns, but because they reduce uncertainty. Silver does exactly that. It stabilizes supply chains. It strengthens infrastructure. It provides physical grounding within a largely digital financial environment, and it does so without requiring belief, trust, or constant management. For outside observers, this behavior can be easy to misread. Without announcements or policy statements, it appears passive, but in reality, it is deliberate positioning, the kind that only becomes visible in hindsight. As China continues to expand its industrial base and modernize its financial architecture, silver's role becomes less about speculation and more about quiet necessity, not as a headline asset, but as a supporting element that systems rely on when complexity increases. This is why silver's importance is growing again, not suddenly, not dramatically, but steadily. And when viewed through this lens, the idea of higher silver valuations begins to feel less like a prediction and more like a reflection of underlying structural pressure. Understanding this shift sets the stage for the next question. If silver's role is expanding quietly within one system, what happens when its valuation begins to signal that change more broadly? That question leads us directly into the meaning behind a number that keeps appearing not as a forecast, but as a signal, and that is where the next section begins. The meaning behind $100 silver, **** numbers often distract more than they explain. When a figure like $100 an ounce appears in conversations about silver, it tends to trigger excitement or skepticism, but the number itself is not the story. What matters is why such a number becomes imaginable in the first place. In isolation, price means very little. $100 today does not represent the same reality it did decades ago. Purchasing power has shifted, currencies have expanded, debt has accumulated quietly in the background. When silver is discussed at higher price levels, it is rarely because silver has changed. It is because the measuring system around it has. This is where perspective matters. Silver has always existed as a relative indicator. It reflects stress within monetary systems rather than creating it. When currencies weaken, silver appears stronger. When confidence stretches thin, tangible settlement regains relevance. The metal does not announce these shifts, it simply responds to them. Understanding this reframes the discussion entirely. $100 silver is not a target or a forecast. It is a signal that something beneath the surface has adjusted, that the gap between physical reality and financial abstraction has widened enough to be noticed. In that sense, the number functions less like a destination and more like a marker. China's interest aligns with this interpretation. Rather than chasing price appreciation, the focus remains on long-term positioning. Silver's valuation is viewed through its role in energy systems, manufacturing chains, and financial optionality. If prices rise, it reflects cumulative pressure, not sudden demand. What often goes unnoticed is how compressed the silver market remains. Compared to other assets, silver trades in a relatively small and tightly managed space. Derivatives and paper claims dominate pricing, while physical supply moves more slowly and deliberately. This separation allows distortions to persist longer than they should until they cannot. When those distortions correct, the movement tends to feel abrupt, even if the underlying causes took years to develop. This is why the idea of higher silver prices feels surprising to many observers. The preparation happened quietly, industrial usage expanded, monetary trust thinned, supply tightened gradually. No single event triggered the shift. It accumulated. For systems like China's, this is not alarming. It is expected. Long-term planners do not react to price signals. They anticipate the conditions that create them. Silver fits into this mindset as a material that reflects systemic pressure without requiring dramatic policy changes. Seen this way, resistance from external systems becomes less effective. Price suppression, market signaling, or regulatory frameworks can influence perception, but they cannot alter physical demand or historical function indefinitely. Eventually, valuation realigns with utility and trust. This does not happen on a schedule. It happens when imbalance reaches a threshold. That threshold is not defined by a number, but by behavior. When silver begins to move less like a commodity and more like a settlement tool again, its pricing language naturally changes. Larger numbers appear not because someone predicted them, but because older frameworks stop working. For the West, this creates discomfort. Financial systems built on liquidity, leverage, and confidence prefer stability in reference points. Silver disrupts that calm not through volatility, but through persistence. It remains useful regardless of narrative. It does not require belief to function. This is why attempts to control silver's signal face limitations. You can manage markets. You can influence sentiment. But you cannot indefinitely suppress the meaning of a material that continues to be consumed, stored, and trusted across systems with different priorities. The idea of $100 silver lingers because it reflects a quiet question. What happens when the measurement tool itself begins to lose credibility? That question does not demand an answer immediately. It simply remains present, waiting for conditions to speak for it. And when they do, the response is rarely loud. It is structural. This realization prepares us for the final stage of the story, where the tension between paper systems and physical reality becomes impossible to ignore, not through conflict, but through contrast. That contrast is where the last chapter begins. Paper systems vs physical reality. **** Modern finance runs on symbols, numbers on screens, contracts layered on contracts, promises referencing other promises. Most of the time, this system works smoothly enough that its abstraction goes unnoticed. People trust the symbols because they behave consistently, but symbols only function as long as the reality beneath them remains stable. This is where the distinction between paper systems and physical reality quietly emerges. Paper markets are designed for speed and scale. They allow assets to be traded, hedged, and leveraged far beyond their physical presence. This efficiency supports global liquidity, but it also creates distance between ownership and possession, between exposure and availability. Silver exists on both sides of this divide. On paper, silver can be multiplied endlessly. Futures, options, and synthetic instruments expand supply without moving a single ounce. These structures serve financial needs, not physical ones. They are flexible, reversible, and dependent on confidence. In the physical world, silver behaves differently. It must be mined, refined, transported, and consumed. Each step carries cost and time. Once used in industrial processes, much of it does not return. It disappears into products, infrastructure, and energy systems, quietly shrinking accessible supply. This contrast creates tension, not immediately, but structurally. As long as paper claims can be settled without physical delivery, the system remains balanced. But when confidence shifts, when more participants seek tangible settlement rather than exposure, the difference becomes visible. This is not unique to silver, but silver magnifies it. Because silver serves both industrial and monetary functions, its physical demand does not pause when financial conditions tighten. Solar panels still require it. Electronics still depend on it. Infrastructure does not wait for market sentiment to improve. For systems like China's, this dual nature matters. Physical access reduces dependency on external trust mechanisms. It ensures continuity even if financial channels slow or fragment. This is not about rejecting paper systems, but about not relying on them exclusively. The West, by contrast, has grown comfortable with abstraction. Highly liquid markets, deep derivatives, and confidence-based valuation have worked well for decades. But this comfort assumes uninterrupted trust. When trust weakens even slightly, the demand for physical settlement increases not out of panic, but out of prudence. Silver responds to this shift without drama. It does not spike on headlines alone. It tightens slowly as physical availability becomes more relevant than paper representation. This process is often invisible until it reaches a point where paper mechanisms struggle to absorb it. At that stage, control becomes difficult, not because systems fail outright, but because they encounter something they were not designed to manage: sustained preference for physical reality over symbolic representation. This is why attempts to stop such shifts rarely succeed. Regulation can influence trading behavior. Liquidity can delay adjustment. Narratives can shape perception. But none of these can create physical supply where it no longer exists or reduce demand where it remains necessary. The shift, when it happens, feels less like a break and more like a realignment. Markets adjust, prices recalibrate, systems adapt. No single decision causes it. No single actor controls it. From this perspective, the question is not whether paper systems will collapse. It is whether they will quietly acknowledge limits they previously ignored. Silver becomes the reference point for this acknowledgement, not as an enemy of modern finance, but as a reminder of what finance ultimately rests upon. Materials, energy, labor realities that cannot be digitized away. For viewers watching calmly, this realization often arrives without urgency. It feels like clarity rather than alarm. The pieces align. The contrast makes sense, and once seen, it cannot be unseen. This prepares the ground for the final section where the story does not conclude with an answer, but with an understanding, a recognition that some shifts do not announce themselves, yet continue unfolding regardless of attention. That quiet continuation is where the story finds its ending. An ending that doesn't close the door, asterisk asterisk. Some stories end with answers. Others end with perspective. This is one of those stories where the movement matters more than the conclusion. Not because the outcome is uncertain, but because it is still unfolding quietly, without ceremony. China's relationship with silver does not demand attention. It does not need validation from markets or commentary from analysts. It operates within a broader pattern of long-term positioning, where preparation happens before recognition. When viewed this way, the focus shifts away from price levels or timelines and toward behavior. What stands out is not ambition, but patience. Silver fits into this patience naturally. It does not force decisions. It does not create dependency. It simply remains useful across different conditions. That quiet consistency is what makes it relevant in a world increasingly shaped by complexity and layered risk. For the West, this presents an unfamiliar challenge. Financial systems designed around confidence and liquidity are highly effective when trust flows freely. They adapt quickly, scale efficiently, and absorb shocks well. But they are less comfortable with assets that resist abstraction, assets that insist on physical presence and real-world limits. Silver does not oppose these systems. It simply exists alongside them, reminding them of boundaries they prefer not to consider. This is why the idea that the West cannot stop the shift is often misunderstood. There is no force to confront, no policy to block, no market to shut down. The shift occurs not through confrontation, but through accumulation, through steady use, through silent relevance. Attempts to control narratives or manage perceptions may slow recognition, but they do not change underlying dynamics. Infrastructure still consumes materials. Energy systems still require conductivity. Trade still seeks settlement that does not depend entirely on confidence. Over time, these realities express themselves. Not dramatically, not suddenly, but persistently. The result is not collapse, but adjustment. Markets recalibrate. Assumptions evolve. What once seemed unnecessary becomes quietly accepted again. This is how systems change when they are too large to move quickly. They shift their weight slowly, almost imperceptibly. For the viewer, this understanding brings calm rather than urgency. There is no call to action here, no instruction, no prediction that demands reaction. Only a clearer picture of how material realities and financial systems interact over long periods of time. Silver becomes part of that picture, not as a solution, but as a reference. A reminder that value has always rested on something tangible, even when wrapped in layers of abstraction. The story feels complete because the pattern is visible. It feels unresolved because the process continues. China will continue to position quietly. Industrial demand will continue to draw from physical supply. Financial systems will continue to manage perception as long as they can. None of this requires an ending. And perhaps that is the point. Some shifts do not need conclusions to be understood. They only need space to be observed. In that space, clarity replaces noise, and understanding replaces urgency. The listener is left not with fear or excitement, but with awareness, a sense that something important is moving beneath the surface, regardless of attention. And once that awareness settles, the world feels slightly different. Not more dangerous, just more visible. That quiet visibility is where this story rests.